Hello my fellow freedom builders and welcome back to the channel. Today's video is about a smell I can smell in the market, and as it says, it smells like, well, .com. And if you are not as old as I am 47, then you might have only heard about the .com crash in around the year 2000, and it was one of the first major crashes I experienced. And today I'm gonna draw some lines where we might see some historical similarities, and there might also be some differences. First of all, before I go any further, remember that there's only 2 days till I pick the first winner of a 1 ounce silver coin, because we're getting close to the 5,000 subscribers. So remember to leave a comment, that is how I find it. Also, if you're kind to support this channel, subscribe, hit the like button, all the buttons you can find down there. Alright, let's get to the topic of the day. Now, this is a picture of the stock market back in the time up to the .com crash in the year 2000. And what I'm going to show today is, as I said, some similarities here. I'm going to tell you a bit about why and how this builds up. And I'm going to show you some of the stocks today in the fast graph software or the platform, where I can show you how prices have run up compared to earnings. So first of all, what we can see here up to 2000 was that the red here is the S&P 500, and that goes up quite quickly, but not at all like the blue line here, which is the Nasdaq, which is the tech. And I know some of you are saying, oh no, not another doomsday video. No, not at all, because I am going to show you some tech stocks of today where you can actually invest and where it is reasonable to expect some profit in the future. But I'm going to give you an overall picture of what I think the overall market is today. So what happened here with the Nasdaq was that we had the internet, and everybody said, yeah, well, the internet is the new technology, tech is the new technology of the future, so how can it possibly go wrong? As you might recall from my earlier video, I heard again and again people saying, this time it is different. We have simply built a way to have a permanent bull market. And as you know, the only thing that is bull in that is the BS. So what happened at that time was that we had companies, first of all, a lot of companies that were absolutely making no money whatsoever. They had a huge burn rate of several $100 million per month, and they had no idea how they would ever turn a profit. Didn't matter, people bought the stocks, and the stocks went straight to the sky. I earned a massive amount of money at that point. But what happened was that these stocks were traded at a PE ratio of 1,000, of 2,000. I saw a PE ratio of 5,000. And after the year 2000, I have held a lot of classes. I've been doing a lot of teaching in investing, and people have been laughing their behind off, simply of the craziness that someone was willing to pay a PE ratio of several thousands for a stock. Well, guess what? They are today again. So our memory, our financial memory is not doesn't go very far back. And now remember this picture here with a huge rise here, a drop, a little retracement, and then a drop back. And then let's go back, 300 years, something like that, to the tulip mania, where it was not tech, but it was tulips that were traded, and we saw pretty much the exact same graph here. Just there's not really any retracement, it just went straight down. And this is happening all over. So what people are saying to me sometimes is, and I can see some critiques in the comment section, they say to me, yeah, well, it is only because of YouTubers like you, Hans, that we have these crashes, because you stir the stability, you make people nervous. And yeah, well, it must have been YouTube and Facebook back here in 1630 that made this, the tulip here, crash, because the exact same thing happens. This has nothing to do with media. It has nothing to do with YouTube or Facebook. They might be able to make the crash come a bit earlier, but the crashes will come. Now, why are these things occurring? Let's just have a quick look at that before I show you some examples. Well, first of all, people are justifying it with saying it is because of new tech. I have told you about this example many times, but for instance, back in, I think it was 2013, 14, it was 3D printing. And 3D printing was kind of the same as EVs, electrical vehicles, are today. It is only, less than 10 years ago, and people said, 3D printing is the new thing. You can print everything. We can send a 3D printer to the moon and it can print an entire moon base for us up there. Well, it might be in the future, but there was not really any earnings there, and things fell again. We saw it with Bitcoins, the blockchain new tech going to the moon, and it dropped. We saw it in the '08 crisis, we saw it at the .com crash, and right now we are kind of seeing it, at least in some areas, some sectors of the market. So people are saying it is because of new tech, and then they just keep buying. And just because something is new tech doesn't mean that if they don't make money, that the stock prices should go to the moon. Then people are saying, we are expecting future earnings. Fair enough. That is a good argument that you want to buy a stock here and you don't mind paying a bit more for it right now because you expect them to make some good earnings in the future. And that is a fair argument. The problem is that if you're paying just a PE ratio of 100, and a lot of these tech companies are priced at a PE of 100 right now, it means that you're paying $100 for every $1 they're making in profit, if they're making a profit at all. But if they are, that means right now you're making 1% per year in maybe a kind of a risky business, but you're making 1%. But you say, there will be future earnings. Let's just say that this business is growing at a rate of, let's say, 100% per year. That is quite amazing if they can keep doing that. I don't know many companies that can keep doing this for 10 years, but let's just say 100%. That means that you'll be making 2% on your money next year, 4% on your money the year after, maybe 8% per year, 3 or 4 years out in the future. But when we are thinking 3, 4, 5, 10 years out in the future, things tend to get quite unstable, and we cannot really predict what will happen in the future. So what you're actually doing is that you're buying something now that even if it were to have an explosion in earnings of 100% per year, it would still not be an amazing business case 3, 4, 5 years out in the future. But then again comes another argument where people are saying, it is not really the future earnings I'm going for. What they are saying, they're not using this term, but what they're really saying is, I am believing that there are greater fools in the market than me. So I'll buy now and everything goes up 100 or 1,000 or 10,000%. And even though it's not making money, I'm hoping for a greater fool to come along that I can sell my stocks to before it all crashes. That is called the greater fool's theory. And there's actually nothing wrong with that because I'm a trend follower. So basically I'm doing the same. I'm saying, I am buying a stock that has gone up at 50 or 100%. And the trend is that it's going up, so it seems like people are pouring in. And when it seems like people are going out, well, then I exit as well. So there's not really anything wrong with this. You can make money, but the thing is that with PE ratios of 100 or 1,000 or 5,000, you have to find some quite great fool to take over your stocks. So be careful of these arguments. It is arguments that we tell ourselves all the time. So let's go to some stocks and see what I'm actually thinking about them. Now, if you have seen my videos before, you might know this chart here because it is from the Fast Graph platform. I'm not affiliated with them in any way, but I'm using it a lot and I can really recommend it. If you want the entire package, I think it is something like $50 a month, a bit steep, but their light version is, I think it is $15 per month, so that is a bit more acceptable for many people. But here I have Facebook, and I've taken all the data I have. The black line here is the price. Here we have the growth in earnings, and here is what's called the normal PE, taking over a historical data set here, and we can see that here we have a PE of 38, and this blue line is what we can expect, where the price should go if we can keep the same PE ratio. Now Facebook, and I know this is not the up to date, this is at the new year here to 2020, there was a PE ratio of 38. Now at that point, the stock was actually cheap. And I had it in several of my videos saying that there could be a lot of money made in Facebook. And I have it in my own US portfolio as well. So right now, Facebook is actually not highly valued, or it's not too overvalued in my point of view here. Because what we can see is that they are expecting growth of 25, 28 and 21%, meaning that the earnings here will be growing. And if a PE ratio of 38 can be held, then we can see that Facebook, let's say over the next couple of years, can actually be making 25% per year to us on our money. So that is not bad at all. And I'm giving you this example just to say that I'm not this doomsday preacher saying that everything is going down in a big black hole, because I actually think there are valuable, good, solid companies out there that will not drop as much in price. But let's have a look at some of the others in this sector. And I can say right away that Facebook is actually one of my favorites and one of the best as to these charts right now. But let's have a look at a couple of others. And again here, I have picked actually a decent candidate, because here we have Google or Alphabet, which you can see have been at a rate for many, many years where you could easily justify owning the stock or buying the stock, because it was actually in cheap territory. The earnings were growing so much that the price could not even keep up. And you can see right now that, okay, it has been in a bit of a slump, but if their estimates are true here, you can actually earn some very decent money, 20% per year, if they can keep the same price earning ratio and if they can keep up the estimates here. Now, when I say if they can keep the price earning, you have to realize that right now, the reason why people are interested in paying price earnings at 30 or 40 or 100 or 500 is because they are expecting growth and good economy and so on. But what we do know is that there might come some instability, some nervousness coming into the market. And all of a sudden people are saying, well, I'm not really interested in paying 100 or 50 or 30 in PE on the stocks. I think 15 will be more suitable. And there's been some writings the last couple of days here as to when at some points the analysts are shifting their focus from growth to value. The second they go down and say, well, now we'll only price the stocks after the fundamentals of the company, will go more for value because that is more certain. At that point, we might see a huge drop in the market. But right now, Facebook and Google here, not much nervousness here. These are actually two very good candidates. All right, let's go to some less solid candidate when we're looking at the fast graph. All right, here we have Apple. That is a darling and a lot of people love it. And it has for many, many years been staying nicely around this PE and earnings line. And what has happened here since, the last year actually, is that the price have been completely decoupled from the inner value, the inner earnings. You can see that they are expecting great growth in their earnings. That is great. But the problem is that at some point, and I don't know, again, as I said in the crash video the other day, I have no idea if this will happen tomorrow or in 5 years. But at some point, investors will shift their focus and say, yeah, well, we might go for some more inner value of the company. And if that happens, let's say in the next 2 years, right now we have a price around 120. If we should just go down here so the rise in price over time matches the rise in earnings, we can see here that we would in Apple see a yearly loss of almost 21%. Does that mean that Apple cannot go up 100% more? No, absolutely not. Then it will just be even more overpriced, and the drop at some point, when a greater fool buys the stock, the drop will hurt even more. Let's have a look at a couple of other examples. Here we look at Netflix, and of course Netflix, there's a lot of competition. We can talk a lot about the qualitative fundamentals here. Will Disney Plus come and take some part of their business and so on, HBO and all of that. But what we can see here is that they have actually been hovering nicely around this blue normalized PE ratio of 104. Now, it might seem like Netflix is a good business right now to own because, well, here a PE of only 93. It is actually lower right now as we speak. But if you look at the point up here, we can see that it might make us 47%, and that can be a bit deceiving because that right now it seems like it is a bit more risk off market. So people are not really interested in paying 100 in PE on a stock. So right now I think it is something like 65. And if we draw this normalized PE line with a 65, it might look more like something like this. And all of a sudden we have some huge drop down to this line. I hope it makes sense that this line is only if the people will be willing to take just as much risk in the future and paying $100 for every $1 of profit. If for some reason that people are saying, no, we think we will put the Netflix on a value scale instead, and we will justify our purchase price due to the inner value. Well, you can see that they have been very good at growing their earnings, 114, 54, 49, 44, 37%. It is really astounding and amazing. The thing is that you have to look at it over a historical perspective here, or a historical time span. And if at some point people start to say, nah, Netflix should be valued as to the growth in their earnings, then even though their earnings are great, we will have to take this one down here. And as you can see, minus 36% per year. If at some point the big institutional investors start to value it as to how has their earnings been growing. So don't be deceived by these huge numbers, because it actually doesn't tell us so much. Of course, it is nice to have a company and a stock that is growing a lot, but if over the last 5 to 10 years the stock has been going completely ballistic and have lost touch with the inner earnings values here, then you can really be in for a very, very bad surprise. Let's have a look at some more. All right, we have Microsoft. A very, very good and solid company. And I actually have it in my portfolio right now, my long-term US portfolio, but I'm also ready to take some profit off the table because try and see what has happened. For many years, we had what is called a lost decade, or even more here, where Microsoft were just going sideways and only making a couple of percent per year, including the dividends. So not much to see there. But then all of a sudden it started to take off. And make no mistake, I love Microsoft as a company. I think it is extremely solid. But right now, when we are talking, and that is actually in the low end here, the PE of 21, but look at their earnings. They have been growing very, very nicely. But again, if at some point the investors, the large institutions starts to say, well, we actually think that a PE of 36 is a bit high. We would like it to come down to normal PE ratio, the historical normal, with a 5% yield for Microsoft. We are talking about minus 15% per year. It can be even more if they want to, let's just have a look at here. If they want to bring it down to the place where the rise in earnings are justified, then we are talking about, again, minus 16%, but that is over the next couple of years, we will be losing 16% per year. I'm not saying that this will happen, but what I'm saying is that this is what we saw happening just before the dot-com crash. We saw everything that had to do with tech. And especially here in 2020, we have seen that after, the virus crash back in the spring, people have been pouring the money into everything that had to do with tech, and especially tech that could help people do business from home and have meetings from home and so on, and home shopping and Netflix, watching movies from home and all that stuff. But at some point in history, it can be tomorrow, it can be in 10 years, at some point, people will start to justify the purchase price with the inner value. As I said in the video the other day, there are times where growth investing is great. There are times where value investing is great. None of them are dead. There are just times where it is risk on, time where it is risk off. And right now it is risk on, but the second we are talking risk off and people are saying we need to justify with some inner value, we will see some sort of crash. It might not be 30%, but we'll see at least some sort of larger retracement in the market. All right, let's have a few more and then stop for the day. Okay, here we have Square. You know, I made a video about it. It is this payment app and this that I mentioned regarding the ARK portfolio. And Square has been a great stock to own. It has been skyrocketing. But what we can see here is that their earnings are not great. And right now this is a PE ratio of 234. Some PE ratios right now is saying 150, 160, and that depends on if you are taking the last fiscal year, the last 12-month period of earnings. If you're taking the forward, meaning the estimated future earnings and so on, that can be different earnings you can look at. But let's just say that the PE is somewhere around 150 and 250. And that is quite a lot. That means that people are willing to pay up to $250 for every $1 of profit. And I know we are using the same argument. It is because it is new tech. It is disruptive and all of that stuff. And yes, that can be true. And we can even look at some great numbers. All right, there is a dip in the earnings here at 33%. But then there are some extremely high estimates. Yeah, well, it is coming from a low place down here. And if at some point investors should say, yeah, well, we can see that they're starting to earn money. They might not be just as disruptive as we thought. So we will be trading it at, let's just say, a PE ratio of 15, which is a good historical PE ratio. I'm not sure it will ever be traded at a 15. But if at some point they should say it, we are talking something like, let's see if I can drag it up, 52% of loss per year over the next couple of years. So it might never go down here, but let's just say that they wanted a PE ratio of 30 or 40, it would still drop significantly. So again, I'm not saying when it will happen, I'm saying that at some point, investors will start to evaluate the market regarding or due to some internal fundamentals of the company and saying this madness cannot go on. By the way, when we are talking about this, Tesla, of course, is a good example of this. Tesla is dropping right now. Now, why is it dropping? There are several reasons, but I just found an article here. Maybe I closed it down, but I found an article with one of the explanations why Tesla was dropping. And one of the reasons is that the S&P 500 committee has decided that Tesla should not be in the S&P 500. There are several reasons. One of them is that they have taken some of their environmental credits from next quarter and dragged into the last quarter so they could show some good earnings. But it doesn't matter why. But now the stock drops because they are not getting into the S&P 500. Now, what does that tell us? It tells us that people have not been buying Tesla because of some inner value. At least some of the investors have been buying it because they thought it was coming into S&P 500, meaning everybody else would buy it then. And we know all the ETFs that are tracking S&P 500, they would have to say, oh, we really need to buy a huge bunch of Tesla stocks because now it is a part of the S&P 500 and we need to mirror the S&P 500. So that means that at least these investors that have been selling out now because it didn't get into the S&P 500, they have been selling because, oh wow, now the others are not buying anymore. I don't want to be the greater fool, so let me sell again. And that just shows us that the entire regime in the market right now is a greater fool theory regime where we are mostly buying stocks. And I'm maybe not talking about you as a person, but as the overall sentiment in the market, people are buying stocks because they know they will go up. They're not looking at dividends. They're not looking at, of course, some are looking at dividends, but many of these stocks that are having a PE ratio of 200 or 500, something like that, people are not looking for the yearly yield here. They're looking for growth in price. They don't care about the inner value, and that can be fine enough. But at some point, it will reverse. Let's just have one more case, and I'll end it for today. And here we have the Zillow Group, which is also one of the stock in the ARK portfolio, also a disruptive company. and they have been going up very nicely, making huge profits for the shareholders. But as we can see, there's not much earnings. And again, people are saying, yes, well, it will come. Look at the estimates, 457% in rise in earnings and 71% in rise in earnings. Yeah, that's all very great, but they're coming from a very low point. And here we have a PE ratio of 164. Up here right now, it is not really there. Let's just say it must be several thousands in price earning. But let's just say that it should drop and people were only willing to pay a PE ratio of 164 here 2 years out. That would give us a loss in Zillow Group, let's just drag it in here, at minus 26% per year over the next 2 years. So when at some point people are starting to say, yeah, well, it is growing nicely and it is disruptive and so on, and even though it is growing its earnings with 457%, there will be a long time before this will be a good investment for us. And we have to remember one thing, looking at the Shiller PE here. The Shiller PE is the overall average of price earnings in the market adjusted for inflation. Tomorrow I'll make a video about inflation because these numbers are completely off, but let's just use the official inflation numbers here. And what we can see is that over the last 20 years, we have had an average of the Shiller PE of 25.6. Right now we are at 35.5. And if we are going back and we are looking at the .com crash, there was actually a point where we were up at 43 or 44 or something of the overall S&P 500 index. Then of course the Nasdaq was a lot higher because that was completely crazy. But we are up in the range now of 35, meaning that it is some of the highest. You can see that back here in 1929 it was at 32.6. We can see that the .com crash was high here. We can see that at the financial crisis here, it was only 26. So right now we are at a point in time. It doesn't mean we will see a crash, but we are at a point in time where people apparently are willing to pay very large prices for some very small earnings. And I know that one of the reasons for this is also the extremely low interest in society. But as I will touch on in my video tomorrow, I hope I'll get around to make it tomorrow, but otherwise Monday, what I'll touch on there is that there might be some pressure upwards on the interest in the future if the Fed is actually correct in their assessment that they will press the inflation up. But that is a topic for another video. So what I'm saying right now is not that we are going to have a crash. Not right now anyway. I'm saying that something is smelling like .com. In a sense where people are willing to pay extremely high prices for very small earnings. And that is something that worries me a bit. I'm still sticking to my own investment strategy, so I am also buying on the trend. I'm hoping for a greater fool to buy my stocks. And as you know from the video yesterday, I have a very strict set of rules, meaning that when a crash comes at some point, tomorrow or in 10 years, I will get out with kind of small losses, maybe 8, 10, 12% of my portfolio. And if the market crashes 30 or 50%, then I'll be ready to buy again when it starts to go up. So just be aware out there that this can happen, and be aware when you're listening to people saying this time it's different, we are in a permanent bull market, then you should consider taking some of the risk off. That's all for now. Take care of yourself and your money out there. Bye for now.